So why do people invest in bonds? Well, the main reason is for diversification, which has the primary goal of mitigating risk from your portfolio. In order to understand this, we have to look at the differences between being a bondholder and a shareholder. As mentioned before, shareholders own equity in a company and they share in the potential successes or failures that a company then experiences. Bondholders, on the other hand, are just loaning money to a company for a predetermined rate of interest, and then once the bond matures, they return your principal or the amount of money that you loaned to them. This differentiation here between owning a part of a company versus just loaning them money makes bonds less risky than stocks, but there's also an important distinction about repayment during a bankruptcy situation. In the event that the issuer of a bond declares bankruptcy, investors holding bonds are much more likely to recover a part of their investment compared to shareholders. This chart from Fidelity helps us to fully understand this. At the very top, you have senior debt holders, which is normally the big banks. Below that, you have subordinated debt, which is where individual bondholders normally fall. In many cases, during a bankruptcy filing, there is still some money left over after paying the big banks, and ordinary bondholders will receive something. From there, you have preferred equity, which is going to be those who own preferred shares of the company, followed by common equity or holders of common stock in the company. The further down this pyramid you go, the higher your risk is of losing everything in a bankruptcy situation and thus receiving no payment whatsoever during their bankruptcy filing. So for that reason, among others, investors will often own a portfolio of stocks and bonds to have less overall risk associated with their investments. And as you get older, that diversification component becomes more and more important. In terms of what percentage of your money you put into stocks versus bonds, well, that comes down to your asset allocation. Most people will consult with a financial advisor on this, but there's a general rule of thumb that many follow called the rule of 120. What this recommends doing is taking 120 and then subtracting your age, and this would be the percentage you would want to have allocated into stocks, with the rest going into bonds. So for example, if you were 20 years old, you would take 120 minus 20, and that would give you 100, or a suggested 100% allocation into stocks. But by the time you reach age 30, if you take 120 minus 30, that would give you 90% recommended allocation into stocks and 10% recommended allocation into bonds.